Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage spreads improving and how the White House is working to try to get mortgage rates lower. First, I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast as the spreads got exactly where you thought they would go.
Yes, we are loving the mortgage spread story as we have all year long. And, the article over the weekend was really trying to highlight, how important mortgage spreads are. So before we go into the other talking points with the government trying to help housing now by verbally talking down the Fed, mortgage spreads. We first want to always talk with how do we look at mortgage rates? It's always the slow dance. The 10-year yield, 30-year mortgage has been doing a little Jodeci, a little Shy, a little bit of Usher, slow dancing for decades and decades and decades. But we like intimate slow dancing. 1970s Soul Train. Remember Soul Train back in the 70s?
Oh, yes, I do.
I don't remember because I was only 4 or 5 years old, but you probably remember.
Setting me up that way.
But in any case, it's really important to talk about the spreads in the last few years. In the last decade, it wasn't much of an issue because spreads were pretty good for the whole decade. But what happened in 2022 is the Federal Reserve went ballistic on the Fed rate hike move, more than anybody anticipated. But by February of 2022, mortgage spreads started to break out as well. That's very typical in other cycles going back to the early 1970s. That's not abnormal. But in 2023, the spreads were starting to get better, and then the Silicon Valley banking crisis made it worse. So we would not have 8% mortgage rates if it wasn't for the spreads getting bad in 2023. And then Powell went very hawkish toward the end of the year, sent the 10-year yield to 5%. Put those together, you had 8% mortgage rates, but that was it. So in 2024, me and I think 3 other people were like, spreads could get better. And then a lot of people thought there's no way the spreads could get better. They could get worse because the Federal Reserve is not buying mortgage-backed securities. That was never really a thing in terms of the spreads not improving. So in any case, spreads got better in 2024, but 2025, it's really critical. We would not have mortgage rates near 3 or 6% if mortgage spreads did not improve like they did. So on an average, 2.54% last year. I looked for 27 to 41 basis points. They improved 42 basis points based on how I track it. And we're closer to 6%. But imagine if they didn't improve. If we're 2024 levels, we're 616 above. If we're 2023, we're 7.25. So that's really important because the next stage of this discussion is, Treasury Secretary Bessent and now Fed Governor Stephen Miron, however you want to say his name, are now vocally going after the Federal Reserve on housing, right? And I think Bessent's exact words were, high interest rates are creating a recession in housing. So it's a little bit different for us because we said the existing home sales market went into recession in June of 2022 is a very traditional recession, right? Sales fall, volumes fall, wages fall, incomes falls, right? Prices aren't crashing, but total volumes and everything fall. Very similar to what we saw in the early 1980s when affordability was slightly worse back then. But now Stephen Miron this morning came out and said housing is in a recession. We need policies too restrictive, right? So I always viewed it as that if the White House could get the 10-year yield just to 380 and spreads improve, not only do you get sub 6% mortgage rates slightly, you can keep it down here and it can help everything out. Where being hawkish now with all this data, this is why I kind of left at Beth Hammock's, the Cleveland Fed presidents. There's no demand destruction out there. I don't know what anybody's thinking about. Like, homegirl, housing permits are in a recession for like years. Housing starts in a recession. We're losing jobs in 2 forms of construction labor. What are you talking about? But it is interesting now that the government is now going after the Federal Reserve just on housing in a year where spreads got better.
Okay, so let's talk about that because, of course, they've wanted a lower 10-year yield for lower mortgage rates since, January, right? Since the inauguration. But how does Trump, whoever he's going to put on this, how does he get the 10-year yield there?
They're going to play New York bully ball. They're going to try to fire
Okay.
everyone they can that is not a Fed governor, because right now they still have the votes for a December rate cut. There's enough.
Okay.
There's enough people there now. For example, Fed Daily came out, says, I agree with the rate cut. I'm not like the Hawks. And, there's a civil war with the Fed, but Trump and them are doing the numbers. And this is why Stephen Myron is up for the Fed governor. I don't know what the hell he's doing there, but he's there. And you can see what they want. So, Pulte was talking about, there's all these millions of lots the builders need to build. Builders aren't the March of Dimes. But when rates get down towards 6%, confidence picks up, sales pick up, you get something going there. So I'm all in favor of this, because there's no reason there's no reason to be very hawkish at this point, where yields are coming down here and spreads are getting better. The bond market is doing God's work for the Federal Reserve. They're doing the heavy lifting without needing the Fed funds rate to go super, super low. And this way, the one sector of the economy which does have aggregate demand destruction can improve just a little bit, and maybe you get housing permits growing, you could get starts growing, we could reverse the jobs that are being lost in construction. Everyone wins. It's only Powell, Gooseby, Beth Hammock, Lori Logan's in the show. So the Civil War is awesome. I'm all for it right now out here. And then the next Fed meeting, you probably do still get a December rate cut. But then going out in 2026, how many people he wants in the Fed, we go with that. So it is good that mortgage spreads got better, because if mortgage spreads did not improve, that 41 basis points peak improvement, boy, we're not even here in the low sixes. It's always mortgage rates getting from 6.64 down towards 6, where the data gets better. This is the third year we've tested that. So I think it's a positive now that mortgage spreads are improving. We still have some room left, 30, 40 basis points left to get back to somewhat normal. And that improves by volatility compressing, Fed keeping the rate cut cycle going. All that could get it. Oh, we could have something workable here, Wheeler. Right? Besson, Byron, and everyone going after Powell and Hammock and everybody. This is lovely. This is great stuff going into 2026.
So, to your point, very good news, since, it's been over 3 years since you said, listen, housing is in a recession. It's in a recession because of the way that the mortgage rates went up so fast. We had that crash in home sales. So great that somebody is paying attention to that and cares about that.
It's almost like somebody showed them a lot of charts and said, this is not good. Like, if you want the economy expanding, you want to start building stuff like everyone's talking about, rates can't be above 7%. But if they just get down to 6, and you could hold the duration curve by forward guidance, talk more about forward guidance, then you could keep it low enough to maybe get something going. So I like this game plan a little bit better than just, trying to like fire everyone and, whatever. Right. But this is a workable game plan. And so it was good to see Myron and Besant work together on that, focusing on housing, because what can Beth Hammock say? Housing markets boom. Remember when the Fed used to say the housing market's recovering, and like purchase application data is like 1995 levels? And I'm like, y'all ever heard Sugar Ray? I Want to Fly? That's the music we were listening to back then. So come on. So I think this was a very constructive last few days on that front to counteract the hawks on the Federal Reserve.
So the spreads, you've been tracking the spreads in the tracker every week. And I think it's really interesting because you always put, here's what the normal spread looks like. Here's where we are now. If we had the worst spreads of like 2022 or 2023, I guess it's 23, it would be this, we'd be here. And if we had the best spreads, we could be here with mortgage rates. And I think that's been really instructive. And I think something that's happened over the last couple months is it just feels like, even though there's a lot of volatility in that macro environment in some ways, it just has not translated at all to the spreads.
There are certain people who, whenever there's drama, they say, oh, the spreads are going to go up, Logan. Rates are going to shoot
Right.
back up. No, it's not, homie. Yeah, it's telling you right now, it's not happening like you think. Okay, the Silicon Valley banking crisis was working from elevated spreads. The Godzilla tariffs, which was serious market drama, did increase the spreads, but only 20 to 25 basis points. So all of this is positive, and I think for those that read the tracker know what I'm talking about, right? For those that have listened to the podcast, you have a good idea, but those that read the tracker get to visually see it. So we've done this enough for the last few years for everyone to have an idea, but there's so many people who've never even heard the word mortgage spread. It's like,
Right.
what are you talking about? So, this is for you guys to realize normal spreads in recent history, not going back early, because spreads used to even be lower than what I'm talking about right now. Normal spreads is 1.6 to 1.8. That's the difference between the 10-year yield and 30-year mortgage rate. That's normal. We got to 3.10% after the Silicon Valley banking crisis. Okay, we moved all the way down enough to where we're at 2.12%, right? So we are only technically 32 basis points from a normal level. That's not much, but 32 basis points as of today gets you sub 6% mortgage rates. You get any help with the 10-year yield going lower. What is that, Wheeler? It is the double whammy effect right there. Remember the game Whammy? Bam, whammy. What are the game show host games?
I don't know if I say yes, are you going to be like, yeah, I don't remember because I was too young.
No,
but
I remember. I think I was like 11 or 12, but I remember the Whammy. That was an awesome game. That little creature out there, and those people like end up losing a lot of money at the last second. We get the double whammy effect of lower yields and better spreads. We had that this year, right? This is one of the things we talked earlier with that, getting the double whammy effect with better spreads and lower yields, labor over inflation. We can get there, right? So I think this year was the fight versus the people that wanted higher rates or believed rates were going to go higher because of deficit spending, treasury supply, inflation, or versus the labor market will guide the bond market in lower. So that's why it's so important for the spreads. Never had to care about it in the last decade or even during COVID. COVID had a brief. You remember COVID the first week, March 9th, 2020, right? Okay. I don't know. We weren't doing our stuff back then, March.
You weren't on the podcast then.
No, I wasn't on. So the first week of COVID, the first day, the 10-year yield was at 32 basis points that Monday morning. I remember I was like, Lord. And for those that don't know, if I see it like an exogenous shock, I have to adjust to it. So my forecast for a COVID, event was negative 21 basis points to 62 basis points. Right, on the 10-year yield. So I had a negative, okay, if COVID hits us, we could be in this range. We got to 32. If we're above 62 basis points, the economy is recovering. It's a crazy concept, but that's the COVID-19 recovery model. The 10-year yield was above 62 basis points. St. Louis Financial Stress Index went down. Believe in your models, Wheeler. We ran the COVID model. We ran all those bears out of the country. In any case, spreads got really bad during COVID, but man, God, I remember tweeting out the first thing. It was like, oh my God, we're going to have a mortgage market meltdown because there's going to be so much EPO risk out there because rates are going to collapse. So after that market drama worked itself out, spreads got better all the way down to, February of 2022. So we are just working our way back to something normal. And usually when you're working from an elevated level down, you run with it lower into the recession. A lot of people say, well, when a recession comes, spreads go up higher. That has happened before, but usually spreads are working from a lower level, then they rise up. So that's the difference, because a lot of people don't think spreads get better during a recession. That's not true. We've had a few economic cycles where the spreads were elevated and they worked themselves lower into a recession. So it can get better. And if the labor
this is my next question. Is like, we've already hit and exceeded your forecast, right? Because your forecast was up to
41. Yeah. 41 basis points was the peak improvement on here.
And we're at 42. Yeah. So can they get better? Will they get better?
Well, obviously, if they get even more better, then I was too conservative with my forecast. However, if I follow the trends and everything still stays the same, where the Fed cuts rates, volatility go down there, we will get to normal levels of the spreads by next year, right? Just like we got to very low levels last year at this time, just like this year, we will get there toward the end of this year. So we can get that action out there. That means sub 6% rates in the 30-year mortgage. And if yields go lower, Wheeler. Oh, it's like in the movie Ghostbusters, Lenny. Think of all those voters you can save. Somebody went up to Trump and say, Trump, Bassett, Myron, think of all those voters that will love to see sub 6% mortgage rates. Go for it out there. And so there's something positive in that. But I just think mortgage spread is such a foreign concept because we've never really had to deal with it. And people are normal. They're not like me. They're looking at the spreads every single day. I'm sure 99.9% of the people on planet Earth have never looked at a mortgage spread chart ever. So,
okay. So where did the 10-year yield and mortgage rates and mortgage spreads go after Friday when we had those, Fed presidents come out and say hawkish things about the December rate?
Well, the 10-year yield didn't really react too much, and the mortgage rates actually fell a few basis points. So that's the benefit of having spreads lower and the 10-year yield lower, right? If you look at the 10-year yield from the start of the year, it's a beautiful. Take a COVID drama out of it. It's a beautiful downward trend, and it's just staying there, right? So the real discussion is starting to become: has the AI boom really masked the softness in the economy? Because there's now consumer companies, that are missing guidance and saying, consumers are a little bit more stressed than what they were. But because of the AI boom and the upper income spending, is that masking the eternal weakness out there? Is the Fed missing this? Because Beth Hammack said there's no demand destruction in any of the data. Where do they find these people? Like literally, if I had a junior analyst working for me that said that, I'd be like, out the door. No, don't come back.
Okay, so let's talk about the fact that even we know that anything below 6.64 and the closer you get to 6, as you already said, that increases demand. If we could even get underneath 6, how much demand are we talking? How many extra home sales are we talking?
To me, it's just it's going to be a couple 100,000 only for home sales.
Okay.
I would tell you this: if you try to run an apples to apples model, the builders are at 2019 sale levels with sub 6% mortgage rates. That would equate to an extra 1 to 1.2 million existing home sales. Okay. But their mortgage rates are like 4.75 to 5.875 in scale terms. The buy downs. There's some that are offering 3.99. In any case, we'd have to have an entire year in between that range to make it anything really like magnanimous or anything like that. So to me, all I've seen is a couple 100,000 home sales. The only problem is rates in the past shot up. And then when they shoot up, it kills, it just sales go lower. So we don't go anywhere. We're just up and down. We're just floating around, bouncing ball at the very low levels. But can you get, rates to 6 or even under 6? We're going to have under 6% mortgage rates now until the end of 2026, but those are ARM loans. And how much sales growth can we get? So very exciting times because inventory's up, right? Price growth has slowed down. Those are the two things I've wanted to see since early 2021. That's happened. Positive for affordability. Now we're talking about sub 6. I mean, come on. That considering everything we've been through, that's not bad.
No, that's really good, especially when you consider a couple of years ago the tagline was "Survive till 25." Mm-hmm. So and lots of people didn't. So great to see some good news about the housing market. Great to see spreads improving. Fingers crossed we don't have any sort of large macro event or otherwise destabilization that impacts that.
Well, anything on the economic bad side now would just push rates lower. I mean, because, once the Fed went into labor over inflation in terms of Powell acknowledging that the labor market is, in a downward trajectory. And here's a really good thing for those people that say the labor market's fine, it's just population growth. If this was the case, wage growth wouldn't be slowing down as much as it has. So it's a softness in the demand curve. Again, it's an interesting discussion. Is the AI boom masking the consumer out here? Right. Is the 200K households really pushing everything? There's all these reference in terms of the economic cycle out here. But the one thing I want to leave this conversation with is you all need to stop listening to those people that said the run on a bank this week because of the repo market.
I got served that out. So you put something on your social on that, and I had seen that guy. They sent it to me as a discover or whatever. I saw him on several things, and I was like, oh my gosh, how many people are going to be like,
these men are jackasses. There's no run on the bank. Okay, my God, the repo market was even in a worse position in 2019. Lori Logan of the Fed, who does New York operations, basically said we're winding down the balance sheets and, we're going to shut off the quantitative tightening, and then we'll manage and start buying assets if we need to keep the repo markets perfectly. There's no run on the banks, 1929. What do we say, Wheeler? It's men in this country, the fragile Fraggle Rocks, the doom porn people.
We say a lot of things.
Come on, y'all. Softest part. Everything is a bank run now. I was like, how many videos I got sent of this one guy? And I'm like, I'm watching the Niner games. By the way, the Niner game. Love that Niner team.
The fact that they could win with their so many of their team injured.
They have over $100 million in salary that's on IR now, and now they might have lost their first round draft pick. But in any case, I don't want to see this same guy like there's going to be a run on the banks. The media isn't telling you no. So, I mean, what do you do? These are the devil's kids running around, orcs and goblins and everything, and the academic world again doesn't do a good job of fighting this. Lori Logan, the New York Fed president, who knows more about this stuff, should come out there and really try to talk this down. You just got to go after these people, just got to crush them in the battlefield, and just no, we're not having a run on the banks because of this. That's not how that's not how the repo market works. There was this kind of drama in 2019, and then it got resolved very quickly, and then we're showing a chair falling down and going, oh, I survived the repo market of 2019. I was like, oh, man, just seriously, man. Y'all, these men need to get AI chatbot, female friends to talk to, and stop doing doom porn online and something, because it's just every time it's always the world's end with this stuff.
No, that's why we have you on, Logan, and thank you for being on, and we will talk to you again soon.